On Business Incorporated today, credit ratings agency Fitch warns South Africa's debt stabilization remains a challenge. And Tanzania signs a $900 million contract with Turkey for rail construction in the country. And Nigeria's travel and tourism sector projected to create 2.6 million jobs in 10 years. Hello and welcome to the program. I'm Will Ibong. We start off as always with market numbers from Africa, where sentiments were mostly mixed at intraday. Nigeria's NGX is in the green, though marginally up 0.03%, while South Africa's index is down 0.02%. Egypt's equities markets closed on Thursday but did finish trading in positive territory, and Kenya continued a positive run up 0.78% to close yesterday. Now to the Middle East, where major equities were mixed also at intraday. The United Arab Emirates, the Abu Dhabi index was down 0.30%, while Dubai was up 1.54%. Still within the region, Saudi Arabia and the Qatari exchanges were closed on Friday, but they went positive at the close of trade on Thursday, as both indexes gained 0.63 and 0.2% respectively. Over to Europe now, where the war in Ukraine is expected to dominate discussions among top diplomats from G20 nations gathering in Bali. The war and its effects on energy and food prices is currently the biggest concern in Europe, which will use the G20 to try and gather support from allies. Stephen Beardsley is right there in Berlin with updates. Hi, Steve. What can Europe, the EU, hope for out of the G20 meeting?
This is a gathering of some of the world's largest economies. For the U.S., the EU, and their allies, this will be another venue to put pressure on Russia to end its war in Ukraine. Now, interestingly, and different from the G7 meetings, which recently took place, this will also include emerging economies such as India, Brazil, South Africa. They have their own perspectives to this war. In the EU, the outlook is clear. It wants Russia to end this war in Ukraine, and it wants it to do it fast, and not just because of the brutality of the war, also because of the historic rupture in relations with Russia that it's led to, but then also because of its effect on prices, growing prices for energy and for food staples. And that's not just in the EU, but also worldwide. We're seeing a growing risk of starvation in the Middle East and North Africa due to the limited exports coming out of Ukraine as a result of this war. That's adding more pressure on nations to push and push and push for something to happen in this area.
Now, pressure has been growing for Russia to allow Ukrainian grain exports. Is there progress on this?
Well, what we heard today from Sergei Lavrov, the foreign minister in Russia, saying today that Moscow is indeed ready to have conversations with Ukraine and with Turkey on this subject. Important to note here that Turkey is a major stakeholder because it is essentially the gatekeeper for the Black Sea region. That's where those exports will come out of. We should also note that there have been multiple instances of evidence showing that Russia has essentially been stealing commodities from Ukraine, from its occupied areas, and selling them on the black market. Time really is of the essence here to find a solution. The UN reporting yesterday that 71 million more people were thrown into poverty as a direct result of this war. That is in 4 months' time. That's a very, very fast rate. There have been more instances of poverty due to the corona pandemic, but that was over a time period of more than a year. This is only 4 months, 71 million people. That gives you an idea of how fast the situation is changing in many poorer regions.
Speaking of markets, talked about the black market, but what can we expect from European markets to wrap the week in terms of, expectations?
This has been a week in which investors are looking for any signs of optimism amid growing fears over recession. And we did see gains in the middle of the week, usually after small bits of news on positive figures out of the U.S. or out of China. But those recession fears are looming ever more. And today we've seen major European indexes coming out in negative territory. All eyes today will be on job numbers for June out of the U.S., and that could again help give sort of a shape to this recession that's approaching, this possible recession that's approaching. It's a very strange time indeed, because on the one hand, consumer confidence is falling, consumer spending is falling as prices rise, and yet for many Western nations, for the U.S., for the EU, the employment picture actually looks quite good. So investors are scratching their heads, trying to figure out what's going on. They're also going to be looking very intently next week at earnings reports for the second quarter for many businesses to get a closer understanding of what they're seeing, what consumers are buying, and how they're investing.
Thanks so much, Stephen, for that update, and we'll watch out next week to see how the meeting, what the outcome of the meeting today in Bali, and how it pans out for the markets next week. Thank you so much, Steve Beasley, for joining us. We'll move over to Japan, to Asia, where Japan's stocks gave up most gains, and the yen rose on Friday on the news of the shooting and killing of the former Japanese Prime Minister Shinzo Abe. The Nikkei 225 was up 0.1% and closed at 26,517.19 points, while the Topix index was 0.27% down. Higher, both indexes were more than 1% higher earlier in the session before reports surfaced that Abe was short while campaigning. The yen last traded at 135.84 per dollar. Earlier in the day, it was at 135.9 per dollar. Elsewhere in the region, Australia's S&P ASX 200 advanced 0.45% to close. South Korea's Kospi added 0.7%, while the Kodak was 1.12% higher at the close of trading. The Hang Seng Index in Hong Kong was up 0.12% in the final hour of trading. And mainland China markets reversed course to close lower. The Shanghai Composite shed 0.25% to close at 3,356.08 points, while the Shenzhen Component lost 0.61%. Now, stock futures fell early on Friday following a rally on Wall Street as investors await a key jobs report today. Futures tied to the Dow Jones Industrial Average fell 0.04%. S&P 500 futures were down 0.2%, and Nasdaq 100 futures slumped 0.48%. Shares of Levi Strauss gained more than 3% after the bell when the retailer reported quarterly earnings that exceeded expectations and boosted its dividend. The action in futures followed a winning session on Thursday in which the S&P 500 posted a 4-day positive streak, marking its longest of the year so far. According to Bespoke Investment Group, the index is now down about 19% from its all-time high in January. Now let's have a quick roundup of yesterday's activities from our correspondent, Maria Bird.
The U.S. stock market showed gains on Thursday as all three major U.S. stock indexes were in the up on Thursday. The Dow Jones closed at 1.1% gains. The S&P 500 closed at 1.49% up, and the Nasdaq showed a 2.28% increase. It is clear that investors are watching to see how the monetary policies will impact the economy. They are hopeful that it will not slow the economy and lead to what could be a recession. But monetary policies are focused on decreasing inflation in the U.S., which has showed a decade high most recently. Interest rates are also on a slight increase. It is also showing that unemployment rates are a bit up in comparison to last month. These are all signs of a potential slowing of the economy, but investors are watching to see if consumers are going to buy in to what these economic trends are stating.
Thank you, Maria. Now, gold firmed early on Friday as the dollar came slightly off two-decade highs. But bullion was set to post its biggest weekly drop in more than a month as elevated greenback hit demand. Spot gold firmed 0.3% per ounce, while U.S. Gold futures rose 0.2%. The dollar edged down from 20-year highs, taking some weight off greenback price gold. Gold prices have lost about 3.7% this week, and it is likely to be their fourth straight weekly fall and worst since mid-May. Spot silver rose 0.5% to $19.28 per ounce, and platinum gained 0.6% to $878.40 per ounce. Both were set for weekly losses as well. Palladium gained 0.8% to $2,006.51 and has gained about 2.3% for the week. Now move over to Africa, where in terms of commodities, we're talking about other commodities. In Benin, some residents are switching from wheat to plantain flours. Prices continue to rise. For small plantain flour business owners, production has almost doubled since the start of the war in Ukraine. The wheat flour becoming hard to find and expensive. Some people see the cooking banana as a viable alternative.
Josiane Hodonu's small plantain flour business has almost doubled its production since the start of the war in Ukraine. With wheat flour becoming hard to find, some people see the cooking banana as a viable alternative. Walking through a plantain field just outside of Porto Novo in Benin, Hodonu is choosing the right fruits for her next batch of flour, each plantain branch costing from $2.30 to $11, depending on the number of bananas per branch. Once she finds everything that she needs, she heads back to her workshop to start the process. Hodonu began producing plantain flour back in 2018 at a very small scale, but lately her production has nearly doubled.
Before the war in Ukraine, I produced at least 80 kilograms per month. But now, because of the war in Ukraine, which caused the price of wheat to increase and made it hard to find in the market, I produce up to 150 kilograms per month when the market is on.
West Africa is facing its worst food crisis on record, driven by Islamist insurgencies that have forced millions of people off their land in Burkina Faso, Mali, Niger, and Nigeria. The region has also seen worsening floods and droughts linked to global warming. The war has disrupted shipping in the Black Sea, a major artery for grains and other commodities, throttling exports from Russia and Ukraine to markets including Africa. Today, Hodonu believes plantain is the way forward.
Generally, we use wheat, which is not local. It's not from here. Now that there is crisis in Ukraine, wheat flour is becoming hard to find in markets and it's also expensive. But we have bananas, plantains at our disposal. We can produce it. So that's why plantain flour has value.
Donc là, la farine de banane a sa valeur là. The start was a bit tedious for Hodonu. She was only able to produce 20 kilograms of flour per month because she had to dry the plantain in the sun. Now using a hydrator, she's able to produce more at a faster pace.
Now, oil prices slipped in early trade on Friday following a rebound in previous session as investors remain torn between worries over tight global supplies and fears a recession could dampen oil demand. Brent crude futures fell 0.4% to $104.26 a barrel, dropping away from a near 4% rebound on Thursday. U.S. West Texas Intermediate crude WTI slipped 0.3%. Both contracts are set to decline for a second week. Trade this week was marked by a sharp sell-off on Tuesday, where WTI slipped 8% and Brent tumbled 9%. Brent's $10.73 drop was the third biggest for the contract since it started trading in 1998. Now, members of the Natural Oil and Gas Suppliers Association of Nigeria, NOGASA, have announced plans to take the crowning growing crisis in the petroleum industry, which has resulted in acute scarcity, high cost of diesel and petroleum motor spirit (PMS), otherwise known as fuel, to President Muhammadu Buhari. The resolution to visit President Muhammadu Buhari was contained in a communique read to journalists by the National President of NOGASA, Mr. Bennett Courier, at the organization's second annual National Executive Council, NEC, and stakeholders meeting in Abuja. Mr. Courier reeled out a number of interventions required to save the downstream subsector of the nation's oil and gas industry from total collapse, including rebuilding and revitalizing Nigeria's 4 refineries, special interventions through the provision of dollars to petrol importers by CBN, the central bank, streamlining taxes to avoid multiple taxations by Federal Inland Revenue Services, and the establishment of Energy Bank through an act of the National Assembly.
The crisis is hitting us. We can't pay our bills anymore, so we need assistance from the government, particularly on this dollar. Because the high cost of this diesel, if you trace it, is as a result of non-availability of dollar. We also ask the government to encourage, if possible, increase crude oil for the modular refineries in the country, particularly some, let me mention one name, Watersmith and others, and this refinery in Niger Delta. That's Niger Delta refinery. Should be given enough crude oil so that they can blend more. For now, all these things are temporary solutions so that we can get somewhere before we sink.
Now, more stories from the African continent after the break. Do stay with us. Welcome back. Higher energy costs is dictating the pace of many economies across the world as fuel prices hit record levels. The negative impact of Russia's oil supply cuts has been far-reaching, and Africa is not left out of this energy crisis. In Mozambique, operators on Monday paralyzed the nation's capital with protests demanding the authorities allow them to increase passenger fares following an increase in diesel price by 11% and gasoline by 4.4%, which is effective July the 2nd. However, bus drivers in Maputo, Mozambique's capital, have agreed to end the strike after authorities pledged to cushion the impact of record fuel prices by subsidizing fares. Matt Kindiger, practice lead, Sub-Saharan Africa Frontier View, joins me now to share his thoughts on this. Hi, Matt. Good to speak to you.
Hi, thanks for having me on the show today.
So, Matt, why has Mozambique been particularly vulnerable to rising fuel prices?
Yeah, so Mozambique certainly is not the only country that's vulnerable, but it has, it is much more vulnerable than many other markets. So Mozambique imports pretty much all of its liquid fuels, although it exports energy, including natural gas. The country imports most of its petrol and diesel, so it's extremely vulnerable to the swings in global oil prices. Additionally, the government has very limited capacity to introduce subsidies to soften the impact of global oil prices. We have seen other governments in some markets introduce subsidies. We've also seen some governments introduce things like social payouts or social subsidies, like in South Africa, to help with the cost of living crisis, but this is not really possible in Mozambique. Additionally, the country has seen a very sharp increase in food price inflation. It's, I believe, at above 13% by the last reading in May. And as a result, we are seeing Mozambicans feeling particularly vulnerable to the effects of rising costs of living. So this is likely a couple of reasons behind the very pronounced protests in Mozambique.
So you talked about Mozambique being unable to implement subsidies, but subsidies on transportation fares, is that sustainable for the economy at the moment? Because that was what ended the strike yesterday.
So we don't think it is. We don't think that a sort of meaningful sort of subsidies over the long term will be sustainable. And this is simply because the government lacks the fiscal capacity to do so. There will be major trade-offs. The government will either have to increase taxes or cut spending significantly. So in our view, they are unlikely to be able to sustain them over the longer term. So, even in countries where they have been able to or the governments have said that they will be introducing subsidies there for very time-limited periods, they generally do become fairly unsustainable quite quickly.
You talked about inflation as well in the country, but how high do you expect disinflation or inflation in the country to reach in Mozambique at the moment or in the near future?
Yeah, certainly. So inflation has accelerated in Mozambique from about 7% earlier this year to around about 11%, according to the last reading in May. We expect it to continue accelerating. It's probably going to reach above 15% year on year by the end of this year. And in terms of an annual average figure, this will be closer to, between 10 and 11% in our view. We would expect inflation probably to begin slowing in 2023, but because global commodity prices will remain quite elevated over the next 12 months or so, we don't expect to see a very meaningful slowdown probably until the end of 2023.
So which other countries in the region are vulnerable to protest over the coming months? We're seeing fuel crisis almost in every African country. So which countries do you think is going to take up the next protest placards and go on the streets?
This is the big question. So we certainly don't think this is the last set of protests that we're going to see in sub-Saharan Africa in particular. We've already seen some unrest in Uganda, but there are a few markets that we think are particularly vulnerable. These are markets where the government has very limited fiscal capacity to subsidize fuels or introduce price caps. There are also the markets where we have seen the most aggressive inflation, especially food price inflation. So a few markets we are monitoring very carefully for risks include Zambia and Zimbabwe. Zambia has very limited fiscal capacity, but Zimbabwe is seeing extremely high inflation. It's back in hyperinflation territory. Ethiopia has also seen a very marked increase in inflation, partly caused by the civil conflict there, but also aggravated by global factors. And Ghana as well, actually, although it was doing economically relatively well, inflation has reached 28%, according to the last reading in May. So it is particularly vulnerable. And then another country we're actually monitoring is Kenya. So although the government has been able to keep inflationary pressure relatively low by global standards, we are likely to see this change after the election in August. And this is because the government's fiscal position is increasingly weak. It has already reduced fuel subsidies, and we expect there to be even less support for households after the election. So there could be a rise in social tensions there. A couple of countries like South Africa are very unlikely to see social unrest directly as a result of higher inflation and fuel prices. And this is because the government is very much committed to countering the cost of living there.
So we hope this fuel crisis pandemic gets, abated soon, Matt. Thank you so much, Matt Kindiga, practice lead, Sub-Saharan Africa Frontier View, for joining us on the program.
Thanks, you too.
Now to other stories. Credit ratings agency Fitch Ratings has warned that debt stabilization in South Africa will remain a challenge as it maintained a stable outlook on the country's sub-investment grade credit rating. The company has affirmed South Africa's long-term foreign currency rating at BB negative, 3 levels into junk status. The decision reflects lower than previously anticipated government debt last year and improved metrics such as the current account balance, partly due to higher prices for commodity exports. The national budget presented by South Africa's Ministry of Finance in February projected that government debt will peak at 75.1% of gross domestic product GDP in 2024 and 2025 and then gradually decline. Meanwhile, Fitch projects debt at 75.9% of GDP for that year and expects it to continue rising beyond this. Now, Tanzania Railway Corporation, TRC, has signed a $900.1 million contract with Turkey for the construction of the Tabora-Isaka section of the 1,219-kilometer Dar es Salaam-Mwanza standard gauge railway SGR project. According to the Tanzanian president, Mrs. Samia Hassan, the agreements were important in furthering the SGR project and would boost the economy and increase domestic rail expertise. The Tabora-Isaka section includes 130 kilometers of main line and 35 kilometers of branches. The construction contract will run for 42 months, with 6 months for testing. On his part, the Director General of the TRC, Mr. Masanja Kadogosa, said the government had so far invested 6.4 trillion Tanzanian shillings in the SGR project. Now, the tourism and travel sector in Nigeria is expected to scale up gross domestic product GDP and create an average of 2.6 million employment opportunities yearly for the next decade. According to the World Travel and Tourism Council, WTTC, economic impact report released recently, the travel and tourism sector in Nigeria is expected to create 2.6 million new jobs over the next decade, doubling the number of those employed within the sector by 2032. According to the report, Nigeria's travel and tourism contribution to GDP is forecast to grow at an average rate of 5.4% between 2022 and 2032, significantly outpacing the 3% growth rate of the overall economy. The WTTC's forecast shows that an average of nearly 260,000 new jobs will be created every year for the next 10 years to reach more than 5.1 million. And that's it on the program. I'm Will Ibong. Thanks for watching.